Hello, I'm Noelle Lim for ASEAN Speaks by Maybank Investment Banking Group. Singapore's first quarter 2022 GDP will be out this week. We discuss Maybank's expectations of growth and interest rate policy responses as inflation grows the fastest in this decade. We also unpack our must-read research, ASEAN Macro Report on Inflation. Winson Phoon, Head of Fixed Income Research, is the host of today's weekly briefing.
Good morning, everyone. It's 8 o'clock on Monday. A quick recap. Last week, global stocks fell. S&P 500, Euro Stocks 50 and the Hang Seng indices were down by about 1 to 1.5%. Bonds extended sell-off. Developed market 10-year bond yields were up 15 to 30 bp last week. Energy commodity retreated slightly with Brent crude prices falling toward $100 per barrel. The US dollar continued to strengthen and the DXY index crossing the 100 threshold. Over the weekend, the French presidential election showed both Macron and Le Pen are leading in the first round, and both are expected to go for a runoff later this month. On Russia-Ukraine, new sanctions were announced on Russia, including bans on the import of coal and a number of other products which were estimated to cut 10% of imports from Russia. Importantly, the ban on coal will be the first on energy import from Russia, and it will be effective from the second week of August, although oil and gas imports are not affected currently. On COVID-19 situations in ASEAN, most countries have reopened their borders to tourists. New infections have been falling, except for Thailand. The concern, however, is on China, and the total number of cases in the past 1 month, mostly from Shanghai, has exceeded the Wuhan outbreak in 2020. The local government in Shanghai has extended lockdowns in Pudong and Puxi. The COVID-0 strategy is causing increased supply chain disruptions, weighing on the economy. And China's composite PMI index in March fell sharply to 44 from 50. And China's State Council last week pledged to use monetary policy tool to support real economy. On US monetary policy, the FOMC minutes released last week suggests that the Fed will likely announce its balance sheet reduction plan at the next FOMC meeting in May. And not surprisingly, the pace of reduction will be faster than the last cycle. I think the current indication is at about 60 billion per month for Treasury securities and about 35 billion per month for agency MBS. And that means a total reduction of about 95 billion per month, probably to be phased in over a period of 3 months. On the US Treasury yield curve, after the curve inversion recently, the 210 spread has steepened back to about 20 bp. And a quick update on the current pricing of Fed funds rate is still quite aggressive, indicating 2.4% by the end of 2022 and above 3% in 2023. And this means a more hawkish pricing than the Fed dot plot. This week, there are a few central bank meetings, but we might see some divergence. On the hawkish end, we have RBNZ, the Bank of Korea, and they are expected to hike rate by 25 bp each. The Singapore MAS will likely tighten further. We have Hak Bin to comment on this later. And the ECB meeting consensus is no change. But on the other hand, we have China's PBOC. Expectation is for them to cut the 1-year MLF rate by about 5 bp. The key macro data to watch out for this week is the US inflation. Consensus forecast is a further acceleration to 8.4% year on year. This morning, we have Hak Bin and Andy to preview the Singapore macro and MAS policy meeting. Suhaimi, a thematic report on ASEAN inflation. Zamros, Philippines inflation print in March, and also Juye, inflation print in March for Thailand. Then on to Thailand equities, we have Jesada, Yuwanee, and Han, and Chee Ting on regional plantations. And let's start with Hak Bin. Hak Bin, you wrote a report with the title Singapore, a Bottleneck Economy.
Hey, hi, morning, Winson. Yeah, so first quarter GDP will be released on Thursday, alongside with the MAS monetary statement. We're looking at growth around 4.5%. That's slower than the 6.1% in the fourth quarter. And that's partly due to the high base for manufacturing and also the stricter travel measures in January due to the Omicron wave. Manufacturing will still lead growth in the first quarter on the back of the strong semiconductor production. But services and construction will continue to recover, but still I think it will be fairly sluggish and may only accelerate from the second quarter onwards with the significant reopening and relaxation of borders only from the 29th of March. So I think in the second quarter, we should see services sectors that have been lagging to be boosted, including hospitality, recreation, F&B, and retail. The reopening of borders will also help increase manpower demand near term, but allow return of commuters and workers from Johor to ease the labor shortage. Bear in mind that for the full year, we've downgraded Singapore's GDP growth to 2.8% from the 3.8%, and that's below the MTI's forecast of 3 to 5% forecast range due to the collateral damage from the war, the higher energy prices, manufacturing supply chains, a weaker EU economy, and China's draconian lockdowns. So there is a chance that the MTI may also reduce its current forecast slightly on Thursday.
Okay, with stronger economy, rising core inflation, and stronger labor market conditions, I think expectations are high that the MS will have to tighten again this week. But markets' views appear to be different in terms of the extent of additional tightening. Like, is it going to be through raising the senior slope, recentering upward, the ban, or even double or triple actions? What is your view on this?
So it looks like it's unanimous that the MAS will tighten this Thursday, but I guess it's how exactly will it tighten? Inflation is rising at the fastest pace in nearly a decade, given rising commodity prices, a tight labor market, and a demand recovery from the reopening. So we're looking for a recentering of the senior ban to the prevailing level and the prevailing level is basically about it's trading at the upper end, of the range. It's already trading at plus 2% above the implied midpoint, in fact, slightly above, according to Anli's model, which he can elaborate. We are not expecting a change in the slope or width of the near band. There are houses out there who is looking at a change in the slope. We think it's not necessary. We think that the recentering will provide more room near term for the Sing near to appreciate anyway and contain imported inflation. But maybe the MAS will likely maintain the current slightly steeper slope, given the worsening growth outlook in the medium term. Because the Russian-Ukraine war, China's fresh lockdowns, rising energy prices, and supply chain disruptions are darkening the growth outlook.
Thanks, Harbin. And we'll loop in Andy, following on the MAS policy, to comment on FX. Andy, I think following what Harbin mentioned, if let's say there's a recentering, what do you think is the impact on the Sing dollar? I think you have an interesting table in your report showing the past performance of Sing Near and the dollar Sing spot after recentering. Do you think this will repeat?
Hi, morning, Winson. So I just want to share with everyone, the spot dollar Sing now is about 136.30 or so. That's against the dollar. As what Harbin mentioned, my model is showing that the Sing Near, the trade-weighted Sing dollar, is currently about 2.1517% above the midpoint. As you all know, the bandwidth for us now in model is about plus minus 2%. So our view is, I think with the recentering policy scenario that is our baseline, expectations is, I think, potential, based on our piece that we reported earlier, potential for about 1% or larger boost to Sing dollar near if the recentering takes place. So on that basis, if you calculate about 1 to 2% range, potentially the Sing dollar against the dollar could actually strengthen from current 136.30 to about 135 or up to about 133.50, 133.60. However, I just want to note that past performance may not repeat itself, but Sing dollar near has been testing the upper bound over the last few weeks. So risk for Sing dollar near is largely to the upside if MAS does choose to recenter. So it's likely to stay on the stronger side of the band, to move up to 1% and above.
Andy, how about the dollar, the DXY index crossed 100 last week? Do you expect additional dollar strength?
Okay, first, that's a very valid question. DXY has actually risen for about 7 consecutive sessions through the end of last week. It moved above 100 for the first time since May 2020. So indeed, the momentum indicators are trending higher. So there's near-term potential possibly into the 150 area and possibly then the high of the April 20 around 185. I think it reached during the panic in March 2022 almost 103. However, there may be very tentative signs that with markets having digested a large part of the recent hawkish Fed messaging, the pace of further dollar upsides could moderate, depending on what happens in Eastern Europe, in Ukraine. But on the whole, we expect broad dollar to still somewhat, hopefully, still stay in elevated ranges, near or just below 100 in the interim. But a spike in the dollar strength from here could be less likely to some extent. But like I mentioned just now, the technicals are showing it possibly reaching a high into 100.5 and then 185 and then towards 103. But we need to break those levels first. Winson.
Thanks, Andy. We'll move to Suhaimi. Suhaimi, you have a thematic report. I think it's quite timely, looking at the inflation dynamics of ASEAN countries, comparing which components have driven inflation higher and whether the drivers are primarily cost push or demand pull. What are your findings?
Hi, thanks, Winson. Morning, everyone. So yes, we look at the dynamics of inflation in ASEAN since last year in a simple framework and straightforward terms, comparing the contribution of CPI components that are sensitive to and thus most directly impacted by the surge in global commodity prices, i.e. foods, utilities, energy, and fuel, against the rest of the CPI's basket of services, which we lump together as others. As mentioned, the purpose is to see whether the driver of inflation is mainly driven by the direct impact of the surge in commodity prices and hence cost push, or whether there is a broadening of inflationary pressure signaling factors like demand pull. I think in short, the analysis showed a broader base inflation in Singapore because foods, utilities, energy, fuel account for only 20% to 25% of inflation in 2021 and 2022 year to date. On the opposite extreme, we have Malaysia and Thailand, where inflation is overwhelmingly cost push because foods, utilities, energy, fuel contributed to at least 80% of inflation over the same period. In between, we have Indonesia and Philippines. In the case of Indonesia, we have around 1/3 and 2/3 split between the contribution of food, utility, energy, and fuel, and the contribution of others on inflation during the period of 2021 and first quarter 2022. And in the case of Philippines, on average, around the split is 2/3 food, utility, energy, and fuel, and 1/3 others in explaining or contributing to inflation in 2021 and first quarter of this year.
Judging from the inflation dynamics you described, Suhaimi, what implication this will have on monetary policy directions of regional central banks?
The takeaway from this inflation dynamics among ASEAN countries is that it validates our assumption, our view of multi-speed monetary policy normalization. And that is something that is happening right now as well. As mentioned, Singapore's broader base inflation has prompted the Monetary Authority of Singapore to be the first of the starting block on monetary policy normalization since October last year. In January, and as mentioned by Harbin earlier, we do expect another round of tightening this month. On the opposite extreme, given the overwhelmingly cost-push inflation nature in Malaysia and Thailand, we are sticking to our calls of modest benchmark interest rate hike of 25 basis points later this year. Bank of Thailand itself said that inflation in Thailand right now is cost-push, demand pull inflation pressure remains tame. Bank Negara go as far as saying that interest rate is less suited to deal with cost push inflation. And given Indonesia's and Philippines inflation dynamics, as I said earlier, is in between Singapore and Malaysia, Thailand. So we expect a larger interest rate hike this year. Indonesia 75 basis point hike in total to start this quarter, and Philippines a total of 50 basis point hikes in interest rate is being penciled in by us starting next quarter.
Thanks, Suhaimi. Still on the topic of inflations, Philippines and Thailand released the latest inflation print for March. We have Zamros and Juye to comment on this. And starting with the Philippines inflation, Zamros, the inflation in March jumped to 4% year on year at the upper end of the BSP 2 to 4% target range. Can you comment, is this primarily due to higher commodity prices or any sign of demand pull inflation?
Hi, Winson. Good morning. Yes, inflation in Philippines jumped from 3% in February to 4% in March. If you look at the what's causing the higher inflation, higher jump in March, it falls down into three categories. The first one is higher utility costs, mainly because of the higher electricity tariff during the month. Secondly, because of the higher food costs, and the third one is a higher transport costs prices, and these are basically very much related to the higher global food and energy prices that we're seeing right now. As far as the demand full inflation is concerned, the economy is still gradually reopening. Unemployment rate is still 6.4%, which is still higher than the pre-pandemic level. And we only expect the output gap, which is currently negative, to only turn positive towards the fourth quarter of this year.
Any thoughts when Philippines inflation will peak, and what is your forecast for 2022?
Looking at the current trend, we expect headline inflation in Philippines to peak towards the middle of this year, most probably June or July. And our forecast for this year, we are looking at average headline inflation of 4.2%. We just revised it upward from 3.4% last week. And our average forecast of 4.2% this year is just slightly lower than BSP's inflation forecast of this year of 4.3%.
Thanks, Zamros. We'll move to Juye. Juye, Thailand headline inflation in March surged to 5.7% year on year, a 30-year high. What caused the spike in prices, and are they mainly cost push or demand pull?
Good morning, everyone. So Thailand's headline inflation jumped to 5.7% in March. That's the fastest pace in 13 years, and it breached the BOT's target range of 1 to 3% for the third straight month. And as Suhaimi had explained earlier, for Thailand, it's really cost push factors that are driving inflation, as the Russia-Ukraine war drove energy and food prices higher. Energy costs jumped by 32%, driven by higher motor fuel prices and electricity bills, while food costs also picked up to 4.6% on the back of higher prices for cooking oil, meat, vegetables, and eggs. On the other hand, when we look at core inflation, it's only a slight uptick to 2% from 1.8% in February. Categories of core inflation remain soft. We still see declines in prices of discretionary items like apparel and footwear, as well as recreation, education, and religion categories. The cost of medical and personal care also remain muted in March.
Do you think inflation pressure will continue in Thailand? Any thoughts when it will peak, and what is your forecast for 2022?
Yeah, sure. So we are looking at inflation to actually exceed 5% in the second and third quarters. First quarter was a 4.7% print. And that's really on the back of elevated commodity prices and the tapering of government subsidies, especially for diesel. The government will remove the 30 baht per litre cap and only subsidize 50% of any increase in fuel prices starting early May. And also there will be more cost passed through to consumers from rising producer prices. Note that in Thailand, the producer price index has surged by 11.4% in March, nearly double the pace of headline inflation. We have recently raised our inflation forecast to 4.8% this year from the previous 2.9%. And our official forecasts have also seen significant hikes. The Commerce Ministry raised its headline inflation forecast to 4 to 5% from the previous 0.7 to 2.4. And BOT has also raised its inflation forecast significantly to 4.9 from the previous 1.7%.
Thanks, Juye. We'll move to Thailand equities, and we have three speakers to comment on this topic. And starting with Thailand Bank, Jesada, you have a positive outlook on the banking sector and you expect it to outperform the SET index in 2022. What are the rationales and any risks to this view?
Good morning. We expect the banking sector earnings to grow about 10% this year due to the economic recovery and pick up in the loan demand and also the lower credit cost with the improving asset quality. And we see the good value in the Thai big banks, especially on the Kasikorn Bank and Siam Commercial Bank, if they can unlock the value from their subsidiaries to increase the return on equity. On the key risks, we see that the Russia and Ukraine tension and also the rising inflation could impact on the Thailand tourism sector and also dampen the consumer ability to service debt.
And what are your top picks on the sector?
And our top picks, K-Bank and KKP, for their strong loan and net interest income growth. And we like the K-Bank strategies to increase the size and scale of the high margin business before unlocking the value, such as the asset management, security company, and also the life insurance. And for KKP, we like this bank for the strong revenue growth and also the attractive valuation with the decent dividend yield.
Okay, thanks, Jesada. I will move to Thailand tourism. We have Yuwanee. Yuwanee, what are the latest COVID restrictions on foreign tourists coming to Thailand, for example, testing and quarantine requirements? Have we seen a rebound in the tourism sector, and what is the prospect for the rest of 2022? And also I think quite importantly, will the absence of Chinese tourists, even though Thailand is opening the border, whether absence of Chinese tourists will be a major problem for the recovery?
Good morning. The latest is that the pre-departure PCR test is no longer required, and the Thai government only need ATK tests on the 1st and the 5th day, and by the 1st of June, where there will be no requirements. You asked about the recovery. The tourism recovery is strong in April because of Songkran holiday. We expect the number of arrivals to total possibly around 400,000 in April, about the same as the first 3 months. This is based on AOT's recently released numbers. Yes, the full recovery will not happen with the absence of Chinese tourists. Still, we do not expect a full recovery this year. We expect the number of tourist arrivals to total 9 million and only expect the full recovery to happen in 2024.
Okay, the 9 million numbers, quickly, how does it compare with pre-COVID?
Pre-COVID is 40 million in FY19. We expect 9 million this year, and next year it will be 22 million, and 2024 it will be 40 million of full recovery comparable to FY19.
Great, thanks. So it's going to be about 25% recovery this year, 50% next year, and a full recovery the following year. And what are your top picks for the sector?
The top picks are AOT and Mint. Both are laggards in terms of share prices. AOT, we like it because it's the main beneficiary of the Thai tourism. It's the gateway to Thailand. And Mint, this is due to the recovery in Europe, the main market where about 50% of normalized income is from.
Thanks, Yuwanee. Still on Thailand equities, we have Han to comment on portfolio strategy. Han, your report mentioned the risk reward for Thailand equities is uncompelling, and you expect the SET index to top up about 1,750. Why is it the case?
Morning, Winson. Firstly, the Thailand equities, they are currently trading at historically expensive valuations. For example, the MSCI Thailand is about more than 18 times forward PE versus 5-year median of 15.6 times. This also puts it as the second most expensive country in MSCI ASEAN, and the third most expensive in MSCI Asia ex Japan. The 1750 level of the SET index is based on the earnings yield gap of 1.5 standard deviation below its 10-year mean yield gap, which then indicates limited upside to the Thai equities performance. And finally, the headwinds such as cost push inflation, as pointed out by Suhaimi and Jui earlier, higher energy prices, and also downside risk to tourism recovery, as pointed out by Yuwanee earlier. These all make the case for a limited upside to the performance in the Thailand benchmark.
How about portfolio strategy when it comes to recommendation for investor positionings? Any idea on model portfolio?
Yep. Similar to Asia ex Japan and Malaysia, we also prefer the value model portfolio in Thailand, primarily based on two reasons. Based on our studies on MSCI indices, value stocks tend to outperform during a rising US yield environment and also inflationary environment, which also applies to the Thailand market. And so far in this Thai value outperformance cycle since 2020, value has outperformed growth by 13%, but valuations are still historically cheap versus growth. And finally, in Thailand, those sectors which are commonly associated with value, such as materials and financial sectors, they are still lagging behind the Thailand benchmark performance year to date. And global trend in the value performance is clear, and we see the valuations for value sectors in Thailand, including energy, they are still relatively attractive when compared historically.
Thanks, Han. We'll move to Chee Ting. Chee Ting had a report on regional plantations, and it mentioned that US farmers are expected to plant more soybeans. Chee Ting, why is this the case?
Morning, Winson. The USDA prospective planting report has surprised the market as it showed that US farmers' intention in this survey was to plant more soybean than corn for just the third time in US history. It will also be a record planting of soybean at 91 million acres, which is 4% higher than a year ago if this materializes. Now, why is this a surprise? It is because at the time of the survey, the soybean corn price ratio was around 2.3 times. Traditionally, when the soybean corn price ratio falls below 2.4 times, farmers will typically plant more more corn planting compared to soybean, given the relatively better corn prices. However, for this year, the high fertilizer prices appear to have induced US farmers to take a more defensive approach in this spring planting season by opting to plant more soybean compared to corn. Soybean is said to require just a quarter of the fertilizer requirements of corn. Hence, US farmers appear to prioritize costs and working capital this year.
And with more soybeans, how will this affect your view on the CPO price forecast and the sector outlook?
Yeah, I think it's the bigger picture is, we are in a critical northern hemisphere spring planting season, and it has just started. As usual, the US farmers will start their corn planting in April, followed by soybean in May. If the farmers miss the window to plant corn in April due to unfavorable weather, they may switch to soybean plantings in May. And since the release of the survey, corn prices continue to ascend, such that the latest soybean corn price ratio has dropped to around 2.1 times. I believe some farmers will take the relatively better corn pricing to try to switch to more corn now. But in any case, the final mix of planting will be published on 30th June in the USDA acreage report. Now, the spring planting window in the in the Northern Hemisphere is not limited to just the US. Planting progress in Canada and Europe, especially Ukraine and Russia, are also equally important and needs to be monitored. There have been talks that the EU and even the US may allow some fallowed land to be opened up for planting during this critical period due to the Russia-Ukraine conflict. Now, the Northern Hemisphere spring planting will be mostly harvested by August and September onwards. At the same time, the availability of foreign workers in Malaysia will also impact output forecast in second half, whereby it is a seasonally higher production period. Our current forecast or assumption is for foreign workers to return to Malaysia in this second quarter as borders have reopened. So we seasonally better palm oil output in second half, which coincides with the harvest of the Northern Hemisphere oilseed. We anticipate CPO prices to ease in second half of this year. So we are keeping our price forecast in view for now, and we are maintaining our neutral call on the sector. Our preferred buys in the region are KL, Kepong, Ta'an, and Umitama Agri.
Thanks, Chee Ting, and thanks everyone for joining the call. Have a good week.
Check out our research reports on Maybank Trade app and speak to your trading rep or contact our sales desk. Happy investing. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.